Hey everyone, Lawrence Hugo Credit Mediation Service coming to you from Alexander Headlands on a beautiful sunrise, and I think it's a good time to talk about the LMI industry very briefly and continuing on from our last clip. So what is LMI? Loan mortgage insurance. It pretty much doesn't cover you and me if something goes wrong with our mortgage. Rather, it covers the banks. And so if the bank is at a material loss after a property is seized or sold, then it will cover the bank in any loss. And then after which, you and I, who are supposed to be insured, will then have to cover the costs for the shortfall. And I'm going to talk a little bit more about that in a few minutes. So the two major players of the LMI in the LMI industry is Genworth, who's one of the original ones going back to the 90s, and QBE. Now there are, little known to most people, there are three private LMI companies, and they're self-insured: Commonwealth Bank, Westpac, and I think National Australia Bank. And so they often do their own internal LMI for some customers under some circumstances. So what's going on with the LMI? So how it all started is back in 1965 when the industry called for greater home ownership. The government wanted to stimulate home ownership in Australia, and they set up a what they call is the Housing Loan Insurance Corporation. And with the Housing Loan Insurance Corporation, it covered the banks who were taking the risk of lending 80% and over for individuals back in 1965. And it was an enormous success. Along with some other indicators in the mid-60s, because of that and other factors, home ownership jumped 70%, and the Great Australian Dream was no longer a dream. It was something that was turning into a reality. So that industry, it grew significantly up until today, and we still have the two major players. So what does the LMI cover? So the case in point, not too long ago we had a client who had a property in a mining town. It's usual story. The property was worth around $800,000 when he first purchased it, and the mine closed down. Property was then worth about $200,000. So it was just a huge drop. The mortgage he had on that was $500,000. He lost his renter because he worked for the mines, and so he was in big trouble. He had to sell his property, and there was a $300,000 shortfall expected. So there's some advice on how to deal with a situation like that. The first piece of advice that we give to customers who are looking down the barrel of what they call an upside down mortgage is simply try and hang on to it. If there is a way that you can hang on to the property without it bankrupting you and riding through this particular difficult period, then it might well be worthwhile just hanging on and just try and survive this difficult time. If you're not able to do that and you are facing bankruptcy, then it might be worthwhile selling the property. And how you would manage that? What a negotiator will do under circumstances like that would simply help the consumer manage the sale process. So in this particular scenario where you've got the $500,000 mortgage, you've got a $200,000 valuation on the property is sold for $200,000, working in round numbers, the property is sold for $200,000, there's $300,000 shortfall. The key point is when it's with the bank will then apply, once the shortfall is realised, the bank will apply for the loan mortgage insurance with, say, Genworth, and Genworth then must approve that LMI. If Genworth approves the LMI, then the debt will be transferred from the bank over to Genworth. And the key time for a negotiator is to get in there and begin negotiating on that $300,000 shortfall right there and then. Because what Genworth will do will then transfer that debt or factor off that debt, sell it off to a debt collection agency. And once that debt collection agency gets their clause into it, they're going to start wanting to collect on that 300,000, and their collection requirements and demands are going to be much more heightened compared to Genworth or even the bank. So the kind of savings you could secure as a negotiator for that kind of shortfall of $300,000, you can reduce that down case by case, but it could be as low as $30,000, 10 cents in the dollar, or it could be lower, 5 cents or 1 cent in the dollar, or potentially a full debt waiver. So if you've got a very good negotiator handling it, you can potentially get that whole debt waived. So that's the LMI, and that's what your potential options for if you have a shortfall in your mortgage. Anyway, I think I'm going to go for a swim. Have a great day, guys. Bye.